In credit, the situation is probably the hardest it has been over the past 10 years or so. If you take credit spreads globally, investment grade, high yield, US, Europe, we are close to the 95th percentile of the historical distribution. That means spreads have been tighter than here only 5% of the times. Does it mean there is no value? No. Dispersion in credit markets is still there, and we see some areas where there is value. In 2025 started with markets waiting a big shift in economic orthodoxy. The new US administration has been shifting from a market-based system to a more power-based system, and one in which markets have a diminished role. Markets were very concerned at the beginning of the year with the idea of funding deficits with large tariffs, with the idea of moving away from markets and approaching foreign relations just with leverage and power diplomacy, and with the idea of explicitly pressuring central banks to cut interest rates. The combination of these factors generated a big scare and a big volatility in Liberation Day. In the second part of the year, though, markets have been moving away from this scare and became more comfortable with the idea of this brave new world. In the second half of the year, I would say starting from May, market came to terms with global growth being solid, around 2% in the US, but definitely not slowing, with tariff inflation not showing up so importantly or so markedly. So core inflation in the US remained around 3%, not substantially higher from the level that prevailed for the past year or so. Fiscal deficits actually improved because tariff revenues were there to fund large tax cuts. Analysts expected 7% deficit in the US for 2025 at the beginning of the year. We ended up between 5 and 5.5. And central banks, especially the Fed, were able to cut interest rates and to signal deep cuts in interest rate for the future, despite economies being okay. So the world shifted and the market shifted from very concerned about the new economic cocktail to comfortable to a situation in which growth is solid and policy support is very strong too. In light of this, markets finished 2025 with almost perfect conditions for global macro. We have solid growth, we have limited inflation, we have fiscal taken care by tariff revenues, and we have central bank cutting interest rates strongly. So no wonder risk assets are at the highs, equity valuations are at all-time highs, credit spreads are at all-time tights, and alternative markets such as emerging markets and crypto are actually booming and doing quite well. The risk is that this economic stabilization comes with a cost. First, the main risk, the biggest risk is inflation. In 2025, we had a record number of interest rate cuts at global levels. The only 2 years in which cuts have been the same are 2008 and 2020, 2 years where global growth was substantially lower. For this reason, we are facing the risk that all this monetary easing eventually shows up in inflation. Core CPI at global level in major economies have been around 3% for now 12 months. The risk is we go to 4 or 5%. If we move there because tariff inflation shows up or because the fiscal stimulus becomes too big, then the new economic setup becomes unsustainable and fixed income markets will need to reprice. The second risk is fiscal stimulus. For now, tariff revenues have been funding a decently high tax cut in the US, and for this reason, global fiscal metrics have remained more or less in check. There have been moments of scare in the bond market for fiscal metrics in US, in UK, in other countries, but more or less the situation have remained in control. The risk is that either tariff revenues prove unsustainable or new stimulus is introduced, and at this point, US deficit moves towards 7 or 8%. This is possible also in a scenario where, for example, global macro starts slowing down, given in 2025 it has been holding up okay despite a weakening labor market. The midterms in October 2026 provide one risk factors for this view. Typically, midterms mean some stimulus coming 6 months ahead, and that would mean first quarter of 2026. Recently, Treasury Secretary Scott Bessent floated the idea of more stimulus aimed at the housing sector, given this housing affordability crisis, and President Trump has been more and more vocal regarding fiscal transfers to the poorer households. The two risks for 2026 are thus inflation and fiscal, or in other way, this is just one risk. The recent cocktail of good growth and policy support proves unsustainable for the global economy. So where is the value, especially in fixed income markets? So government bonds are tricky, especially the front end and the belly of the curve. The reason is that real interest rates have been compressing throughout the year, and it's possible, and central bank cuts are very well priced in the market. The risk is that inflation comes up, and for central banks, it's difficult to cut interest rates so deeply. So this part of the global fixed income market is one area where we see some risk. Duration is probably a bit more attractive because the same risks prevail, but we had a decent repricing this year. During 2025, several global curves steepened from almost flat to 100 to 120 basis points, which is a level which is fair to cheap, or in other words, there are areas in which fiscal concerns are probably overpriced. For example, UK and Europe are two areas where we see some value in long-end bonds. In credit, the situation is probably the hardest it has been over the past 10 years or so. If you take credit spreads globally, investment grade, high yield, US, Europe, we are close to the 95th percentile of the historical distribution. That means spreads have been tighter than here only 5% of the times. Does it mean there is no value? No. Dispersion in credit markets is still there, and we see some areas where there is value. In financials, for example, we see value in selected front-end hybrid bonds, so selected AT1 with short calls, and we see value also in some long-dated senior bonds, especially in US and UK curves. In corporates, we see little value in some areas which have performed very well recently, for example, corporate hybrids, but we see more value in selected sectors. In US, we see value in utilities. In Europe, we see value in property bonds, both commercial and residential. And in general, we see value in selected investment-grade names with high duration, both because of the rates and the spread component. In emerging markets, credit becomes hard to own at the moment, given it went tighter and tighter with global credit, but local currency bonds are interesting. Those bonds offer real yields between 5 and 10%, and for the first time in a while, you have weakening global growth, so weakening growth in emerging markets, together with dollar softness. That means for emerging market central banks, it's relatively easy to cut interest rates a lot, especially starting from a big real yield cushion. So there is less value in credit, more value in local currency.